Performance evaluation, a new development is the balanced scorecard. Now, the balanced scorecard incorporates financial and non-financial measures in an integrated system that links performance measurement directly with the corporate strategic goals. Now, this is a recently performance from a series of perspectives from the customer's point of view, from internal process developments, and from learning. Now, many companies have developed non-financial measures. For example, in the automobile industry, they look at capacity utilization of plants, the impact of strikes, brand loyalty of customers. In the computer systems, their market profile of customer end products. They evaluate themselves on the number of new products, on the amount of involvement employees have in ownership of the company, and the number of scientists and technicians that they use in R&D. All of those are non-financial measures. In chemicals, customer satisfaction data, number of patents. In banks, the number of ATM by state, number of products used by the average customer, the credit card retention rates. All of these are non-financial measures of performance. Now, from the balanced scorecard, we have the four perspectives: financial, customer, internal, and learning and growth. Now, of course, financial, we must be profitable. So we're evaluating managers on the return on assets, on net income, on share price, on profit per employee. These are all financial measures that they will use to evaluate the performance of different managers. From the customer's perspective, they look at the percentage of customers who would recommend their product, customer retention, response to new customer requests, customer service expense per customer. They look at all of those objectives. In internal processes, you as a manager are responsible for improving on those processes, and so they're going to evaluate on planning accuracy, on waste reduction, on labor utilization rates. All of these processes they want you to improve on, and these are non-financial. Learning and growth, the percentage of employees who are taking courses, the percentage of employees who are leaving, the training hours, the ethic violations, the number of cross-trained employees. All of these are ways in which a manager today is evaluated. In summary, the balanced scorecard does the following. It employs, as you've seen, both financial and non-financial measures. And it links those so that high corporate goals can be communicated in a way down to the shop floor. It provides measurable objectives from both such non-financial measures and financial. It integrates all of the company's goals into a single performance measurement system so that an inappropriate amount of weight will not be placed just on one single goal, as it was in the past with finance. Now, I've seen managers sit down at the beginning of the year and identify where they're going to improve in the financial area, in the customer area, in internal processes, and in learning and growth. And they set those at the beginning of the year, and then they're measured against what they set at the end of the year to determine their evaluation for the year. So then, to summary, which of the following four prospects in the balanced scorecard is most likely associated with the objectives? Percentage of repeat customers. Well, the number of suggestions for improvement from employees, learning and growth. Contribution margin is the financial perspective. Brand recognition, customer. Number of cross-trained employees, that satisfies the learning and growth perspective. Amount of setup time, internal process. So I think you get an idea that performance evaluation has expanded from financial to non-financial perspectives in the past few years.